Silver just hit $58 per ounce on December 5, 2025. That's a 100% gain this year alone. The metal doubled in 12 months, touching an all-time nominal high of 58.47 on December 3rd. But here's what should alarm you. While paper silver, the futures contracts traded on exchanges, shows record prices, physical silver, the actual metal you can hold, is nearly impossible to buy at those prices. Premiums have exploded to 8 to 15% over spot. The United States Mint continues rationing Silver Eagle production. COMEX registered inventories sit at historically low levels, and Shanghai futures exchange warehouses just hit decade lows. The price you see quoted, $58, that's not the price of physical silver. That's the price of paper contracts. And right now, the divergence between paper and physical is exposing a truth the financial system doesn't want you to understand. The silver market is breaking. Let me start with what's happening right now. Silver spot price as of December 5, 2025 trades around $57 to $58 per ounce. That's up from approximately $29 on January 1st, a 102% gain year to date. But try buying physical silver at $58. You can't. Dealers are charging $63 to $70 for 1-ounce coins depending on product. That's an 8 to 15% premium over spot. American Silver Eagles command $10 to $15 premiums, and delivery timeframes stretch from immediate to weeks or months depending on mint capacity and product availability. The U.S. Mint has been struggling with silver supply constraints for years, but 2025 made it critical. Issue isn't silver availability in the ground. The problem is getting physical silver delivered at paper prices. The mint doesn't produce its own blanks, the raw discs stamped into coins. It relies on third-party suppliers, primarily Sunshine Minting. Those suppliers can make better margins selling their own finished products than selling blanks to the mint at restricted contract prices. Federal regulations require the mint to purchase domestically sourced silver at prices at or near spot. But in the current market, physical silver requires premiums. Suppliers who can sell finished products to private dealers at $65 to $70 aren't incentivized to sell blanks to the mint at $58. So the mint receives minimum contractual deliveries, nowhere near enough to satisfy public demand. Now let's talk about COMEX, because this is where the structural fracture becomes visible. The COMEX is the primary exchange for silver futures in the United States. When you hear the silver price, that's COMEX. The exchange maintains physical silver in approved warehouses divided into two categories. Registered silver is available for immediate delivery against futures contracts. Eligible silver sits in COMEX warehouses but isn't available for delivery. As of late 2025, COMEX total inventory sits around 300 million ounces. But registered silver, the amount actually available for delivery, fluctuates between 40 to 60 million ounces. Meanwhile, open interest representing outstanding futures contracts exceeds 600 million ounces of paper claims. 600 million ounces of paper backed by approximately 50 million ounces of deliverable metal. That's a 12-to-1 ratio. We've seen repeated stress signals throughout 2025. Silver touched $35 in October before the real breakout began. In November and December, silver surged toward $59, reaching all-time highs. During these rallies, registered inventories experienced sharp drawdowns as physical delivery requests increased. The exchange accommodated by transferring eligible to registered. But that's not sustainable. Once eligible transfers to registered and gets delivered, it exits the system entirely. Total COMEX inventories peaked above 400 million ounces in early 2021. They've declined over 25% since. Shanghai tells an even more dramatic story. Shanghai Futures Exchange silver inventories hit decade lows in November 2025. China, the world's largest industrial consumer of silver, is physically removing metal from warehouses. They're not speculating on paper. They're securing physical supply for manufacturing. When the globe's largest buyer is hoarding physical, that's a critical signal. London shows similar patterns. Record silver volumes moved into London vaults in November, but this represents concentration, not abundance. Silver is being pulled from Shanghai, shipped to London, and locked up by entities waiting for higher prices or securing long-term supply. Now let's examine why this demand surge is structural. Silver isn't purely monetary. It's a critical industrial commodity. Industrial fabrication accounts for over half of total demand. Solar panel production is the primary driver. Every solar panel requires approximately 20 grams of silver. No commercially viable substitute matches silver's conductivity at scale. Global solar capacity is expanding at unprecedented rates. Industry analysts estimate solar will consume over 25% of annual silver supply by 2030, up from 15% currently. Electric vehicles use 50 to 100 grams of silver versus 15 to 25 in traditional cars. Global EV production exceeded 18 million units in 2024 and continues accelerating. And 5G infrastructure deployment adds structural demand. Industrial silver demand in 2025 exceeded 900 million ounces. This demand is price inelastic. Industrial users need physical silver. They cannot substitute paper contracts. Investment demand is simultaneously surging. Silver-backed ETFs added 200 tons in early December 2025, the largest weekly inflow since 2022. Total global ETF holdings now exceed 839 million ounces as of December 3rd, the highest since mid-2022. After 3 years of outflows, the trend reversed in 2025. Every ounce flowing into ETFs gets pulled from available supply and locked in vaults. Central banks and sovereign entities are also accumulating silver, though less publicly than gold. Evidence suggests Chinese state-owned enterprises are building positions. Why? Because silver at $58 is historically cheap relative to gold. The gold-to-silver ratio currently sits around 73 to 1. It fell from over 107 in April 2024. But historically, the ratio averaged 15 to 1. Silver remains undervalued by a factor of nearly 5 based on historical norms, so you have industrial demand at records and accelerating. Investment demand reversing to inflows, likely sovereign accumulation. All demanding physical metal. Meanwhile, supply remains constrained. Global mine production in 2025 was approximately 850 to 900 million ounces. Most silver, roughly 70%, comes as a byproduct of copper, lead, and zinc mining. Silver supply doesn't respond elastically to price. You need new base metal projects requiring 5 to 10 years for development. Total supply around 1 billion ounces. Total demand exceeded 1.2 billion ounces. That's a deficit of 200 million ounces. The Silver Institute projects 2025 marks the 5th consecutive year of deficits. Cumulative deficits from 2021 through 2025 approach 820 million ounces. Where does deficit supply come from? Above-ground stocks. COMEX warehouses, LBMA vaults, private holdings. But above-ground stocks are finite. And as visible inventories decline, markets recognize scarcity. That's when premiums explode. That's when paper and physical diverge. Now let's connect this to the empire pattern because this divergence has preceded every currency crisis in history. Ancient Rome debased the denarius from 95% silver to 5% over 2 centuries. Officially, the coin retained value, but merchants understood. They demanded more coins or payment in gold. The official price was fiction. In the 1960s, Bretton Woods pegged the dollar to gold at $35 per ounce. But the United States printed dollars faster than it had gold. France demanded physical gold instead of holding dollars. The London Gold Pool tried maintaining the peg by selling gold, but demand overwhelmed supply. In 1968, the pool collapsed. By 1971, Nixon severed the dollar-gold link. The pattern is universal. Empire debases currency. Official and physical prices diverge. Authorities attempt maintaining the fiction. Eventually, physical demand overwhelms paper. The system breaks. We're watching this with silver right now. The COMEX price quotes $58, but physical trades at 65 to 70 with delays. That spread is the market screaming the paper price is fake. Here's the mechanism that breaks the system. When paper holders demand physical delivery, the fractional reserve fractures. COMEX has 600 million ounces of paper backed by 50 million registered. If even 10% demand delivery, that's 60 million requested against 50 available. The exchange cannot deliver. They either default by forcing cash settlement or transfer eligible to registered, depleting inventory. Both undermine confidence. We've witnessed stress all year. December 3rd, silver hit 58.79, an all-time high. Delivery requests increased. COMEX transferred eligible to registered, but each transfer reduces total inventory when delivered. Questions persist about double counting. Silver reported by ETF stored at JP Morgan might simultaneously appear in COMEX reports. If true, actual silver is less than stated. This compounds doubts about paper market integrity. Now let's talk about what happens when the paper market breaks. When the London gold pool collapsed in 1968, the official gold price stayed at $35, but the free market price shot up. By 1980, gold hit $850. The official price became irrelevant. The same will happen with silver. The COMEX price might say $60, but if you can't buy physical at 60, the COMEX price is meaningless. The real price is whatever physical trades for. Right now dealers charge $65 to $70. That premium will grow, $10, $20, $30. At some point the divergence becomes so extreme that confidence breaks, traders demand delivery. COMEX can't deliver, contracts default, price discovery shifts entirely to physical markets. When that happens, several things occur. First, spot price becomes meaningless. The real price is whatever physical clears at, could be 80, could be 100, could be more. Second, shortages intensify. Every investor tries converting paper to physical. Mints are overwhelmed, dealers run out. Third, industrial users panic and start hoarding. They pay any price to secure supply. This creates bidding wars. Fourth, the question stops being what's silver worth in dollars and becomes what are dollars worth in silver. Now let's talk about silver specifically in the empire framework. Gold gets attention, but silver has unique characteristics. First, silver is accessible. An ounce of gold is $4,000. An ounce of silver is $58. Regular people can buy silver. Second, silver has structural industrial demand independent of investment. Solar, EVs, 5G aren't going away. Third, silver supply is inelastic. Gold gets recycled. Silver is consumed in industrial uses. Above-ground stocks are declining. Fourth, silver is more volatile. The market is smaller. When money flows in, prices move violently. 1980, silver went from $5 to $50 in months. So here's the empire pattern. Late-stage empires debase currency. Dollar money supply has expanded massively since Nixon closed the gold window. Federal debt is $35 trillion. When empires debase, people flee to hard assets. We're in early stages. Silver doubled in 2025, but the physical market is fracturing, premiums exploding, inventories collapsing. Mints can't keep up. This is the canary dying. The system is telling you physical is scarce even though paper says abundant. Now, what do you do with this information? I'm not giving financial advice. I'm showing you a pattern. The spot price is increasingly disconnected from physical silver you can actually buy. That spread will likely grow. If you want silver exposure, understand that paper silver, ETFs, futures, these aren't the same as physical. Paper gets settled in cash during crises. Physical is what matters. Second, timing is uncertain. I can't tell you when COMEX breaks. Could be months, could be years, but the trend is clear. Physical demand is overwhelming paper supply. Historically, these breaks happen faster than expected. The London gold pool held for years, then collapsed in weeks. Let me give you the timeline. We're in early warning. Premiums 8 to 15%. Inventories declining. Visible stress but system functioning. Next is stress phase. Premiums explode to 20 to 30%. Mints ration. Month-long waits. This could last months or years, then comes the break. Something triggers delivery rush. Confidence breaks. Everyone tries converting paper to physical. COMEX suspends delivery. Paper price becomes irrelevant. Physical trades at whatever clears. Then the reset. New price regime emerges. This pattern played out in Weimar, Rome, every currency crisis. Early warnings, most ignore. Stress, some scramble. Break. Panic, reset. Those who held hard assets survive. Those who trusted paper lose everything. The mints running dry, premiums exploding, COMEX inventories collapsing, these are early warnings. Most see spot at 58 and think silver is expensive. They don't understand 58 is a paper price. They don't understand physical trades at 70 with delays. The time to position is before the break is obvious, because once it's obvious, the metal is gone. This is the empire economy, where we decode patterns that repeat as empires decline. The silver shortage signals currency debasement. Late-stage fiat system stress. Smart money moving from paper to physical. The canary is dying. The question is whether you're paying attention.